So today's paper is titled Conditional Portfolio Optimization. I felt like it was a very interesting paper because it reveals a lot, but at the same time doesn't reveal much at the same time. More to that will come. I'll explain further. So a little bit about me. My name is Masimba Gona. I am a junior quantitative researcher at Hudson and Thames, and I'm a proud VC, meaning that I graduated at the University of Witwatersrand here in Johannesburg. I graduated with a master's in mathematics and decided to then switch to quantitative finance simply because I wanted to try and explore how I can add more value in the space, given my strong background in mathematics. But I slowly realized that quantitative finance is just one third mathematics, two thirds finance, and actually technical skills. But over the past few months and a year or so, I've gained enough experience, enough knowledge to actually have a say or actually have an opportunity like this one to be working for us in the teams and actually conducting a reading like I am today. So, like you have on the screen here, I derived an interesting quote from the paper itself, where they said that past performance is not indicative of future results, and I feel like quantitative analysts or researchers should live by that. But anyway, let's go on. So I partitioned the slides or the presentation into 8 main sections. The first section is going to be the introduction. We're just gonna do a bit of repetition, maybe things that you already know, but we're just gonna talk about traditional optimization methods. And then we're then gonna compare those to what the authors labeled as machine learning methods and see how the two actually flare against each other. And then we're gonna talk about the core concept of what exactly is CPO and how, for instance, perhaps this paper adds to the community. Then when we look at the methodology and looking at how CPO actually works, it's a two-step approach. And then after that, we're going to look at the process, exactly how it works, the bare bone, try add a bit of flesh to it, and try to understand the actual thought process behind the construction of the model processing and so forth. And then we're going to look at the results. Some may be controversial. We'll look at those. And finally, I have my own personal concluding remarks and my own personal thoughts regarding the paper. So I think without further ado, let's start. So, like I said, perhaps this is a bit of repetition in itself, but nevertheless, I think it's worth mentioning that traditional approaches to portfolio optimization typically involve using mathematical models. This is to construct a portfolio to maximize your given risk, also to maximize your returns given the level of risk. And I think that's textbook. That's something if you're probably learning quantitative finance, you would have learned. That's essentially what sorry, that's essentially what traditional methods involve in terms of trying to optimize your portfolio. Now, in order of maybe more naive to more advanced, some of these methods involved equal weighting, risk parity, and mean variance, aka Markowitz. But now, all of these approaches do not typically account for changes in the market or consider the impact of market regimes. When we say market regimes, we're just looking at shifts in the market and how, for instance, investor confidence changes and how the markets just generally change. And I think this has become even more relevant in our times where we see sudden shifts in markets happen so rapidly. For instance, I think in the space of 5 years, we've had the COVID-19 pandemic, and we also had the war in Ukraine. Just two significant market shifts that have happened. And the authors are suggesting that CPO will be able to pick up those regimes and those changes and be able to adapt. And there's an interesting example that we'll go through that actually shows results in which this actually occurred and the model managed to actually adapt and still maintain a good return. Okay, so just a comparison now. We've already talked about traditional methods, as in the sense that they focus on constructing portfolios that maximize returns or minimize risk under a single assumption or constraints, aka this could be a Sharpe ratio, or if you think about the Sharpe ratio, trying to maximize the denominator or minimize the numerator. Now, these methods assume that asset returns are normally distributed, or usually assume that asset returns are normally distributed. Think there are methods to combat this, but it's not always foolproof. So that poses as an issue at times, especially when you're doing financial modeling using traditional methods, and not just in portfolio optimization. I think this applies a lot in a lot of quantitative finance. And another big assumption, which is why then the authors wrote the paper, is that traditional methods traditional methods assume the market conditions are stable over time. Perhaps maybe this is more naive because that has never been the case. History has shown there's been big market changes or market regimes. I think a very simple market regime or context could be just a bull market versus bear market. We've seen shifts of up and down bull markets, bear markets, and a lot of traditional methods always assume that the markets are stable. So this almost trumps the fact that traditional methods perhaps should be scraped away and we should focus on machine learning methods. So in contrast, regime change methods, aka machine learning methods, take into account changes in the market conditions by actually identifying different regimes or states that characterize the market at different times. And this is huge. This is why, for instance, the authors release the paper. And this is why I feel like it actually adds value to the community because of that fact that by taking some sort of inputs, we can essentially bring out a way we could optimize the portfolio by accounting for the current market changes or market shifts that are happening now. Another point to consider is that regime changes methods recognize that asset returns and correlations can vary significantly across different market regimes. And this is also a big one too, because I think with traditional methods, especially when you look at the naive one, which is accounting for only correlations. I think I remember when I was starting off quantitative finance, just reading from the textbook, a simple way to diversify a portfolio or to essentially optimize the portfolio is just to account for different correlations. So having assets that are uniquely different from each other so as to diversify your risk. Now, machine learning takes that a step further by actually aligning those with the market shifts that are happening as they are happening, or at least try to do that. And then another point is that regime changes can provide more robust and adaptive portfolio allocations that can perform better in dynamic market conditions where traditional approaches may actually not be able to do so. This is also quite significant, and robust can also be taken with a pinch of salt because we know that whenever a model in machine learning is a bit complex or complicated, it tends to exhibit signs of high variance or it tends to overfit. But we'll see examples whereby when they tested their model with in-sample data versus out-sample data, they may not be actually a big change or shift. But however, there's more to come, and I think we'll just talk about that when we get to that section. So now the question is, what is CPO and what is the concept behind the paper? Now, I decided to ask the question of how to actually answer the core concept of CPO, which is given a hypothetical portfolio. Now, this portfolio could be anything, assuming it could be Forex, it could have bonds, it could have whatever you want. There shouldn't be any limit to what you can include in your portfolio. And so given a hypothetical portfolio and information about the market environment, key point, can I predict an objective function that I care about? Now, the objective function can be anything you want, given your investment preference as a manager or as a researcher, whatever the case is. Can I manage to predict or optimize, we'll see that, an objective function given market environment and this hypothetical portfolio? And CPO turned out to be the answer to that question. So the methodology now. Now, at the core concept, CPO is a two-step approach, and firstly involves regime identification. So in the first stage, the machine learning model is trained to identify different regimes based on historical market data, which is the first part. Now, the authors mentioned that they used neural network, but they did mention, sorry, the fact that they use that lightly or to just maybe per se to make it easier to maybe to explain, but in actual fact, they use some sort of gradient boost regression tree, i.e. potentially an XG boosting model. And this model will be used to be trained on historical data to try and actually pick up the regime changes in the market. And and from my own research, I feel like this could be also substituted with potentially any model that you prefer. I personally prefer the hidden Markovian model because of its ability to identify latent states and time series, and the fact that it actually tries to put more weight or emphasis on recent events rather than the past events. But that's just a personal preference. And then the second part of the two-factor approach is actually portfolio optimization. This is where now, after the model has been trained on the historical data with your two inputs being your, like you see on the diagram here, your control features and market features. I will explain those. It then is now a trained model. And then after it's been trained, you can then now try use that with certain constraints to then actually optimize your portfolio and see which allocations are optimal for, let's say, trying to get the best objective function. In the case of the paper, they used Sharpe ratio, or rather the one-day Sharpe ratio in most of the examples. But like I said, this objective function can be anything you want. It's just based on your preference as an investor and so on, which is why I feel like the actual methodology and method is actually more of a skeleton and can be filled in with anything you want in terms of the flesh you'd want. So at the core concept is using machine learning to identify and adapt to different market regimes and improve portfolio performance over time. And we know that with machine learning models, they actually get better with more time. They learn to learn, especially when you use XG boosting models or even hidden Markovian models or neural networks or deep learning of some sort. Anything that has some sort of reinforcement learning in it, we know that machine learning models get better with time and with more data, of course. So that is at the core concept of what CPO is in context of actual paper. Um,
Yeah, so Masimba, I just want to interject. So um I think maybe just said slightly differently, this is probably the most important thing to understand about the concept is um so you have two steps. What essentially you say is given my control features and the market features, I want my model to learn to predict some kind of objective function. And the example they used here was the 1 month into the future Sharpe ratio. And so the first step isn't actually about doing any kind of optimization. In a later slide, you'll see there's actually multiple steps. So the first step is, can I just create some kind of model that, given a hypothetical portfolio, the control features, and the current state of the market, can I just take those two things and predict what my Sharpe ratio will be in the future, 1 month from now? So that's the first step. And so the idea is just, can I map a portfolio plus market features to a Sharpe ratio? And you figure out how to do that across all different portfolios given the current market features. And then once you have that model that's trained, that now understands how market features will affect the portfolio, then you start saying, okay, how can I tweak my control features, essentially, because the control features are these levers you can pull, the weights that you can shift around. How do I tweak those so that I end up with a maximum Sharpe ratio at the end? So it's slightly different to how a lot of models would typically, or to a lot of approaches that you typically take. It's not going, find me the maximum return. It's going, find me any return given a control features and any set of market features. And so that's why you can see in this diagram, the control features are all different. It's different weightings of the portfolio, but the market features are all the same. And that's the kind of key idea here. And so the aim and the hope is that internally the model will develop some kind of understanding of market regimes and how it will affect the portfolio. So that's the kind of key idea behind CPO. Cool. Thank you,
yeah,
Mr.
thank you, man. Thank you, Michael. Yes, yeah, I love that you're reiterating that there is no optimization in the first step. It's just training and learning and just teaching the model given these market regimes. So for instance, if you see the diagram here on our right, um, we have two inputs. We have control features. Control features will be essentially what will make up your actual portfolio. So in this case, we have three assets. You have your Google stock, your Microsoft stock, and your Apple stock. And then you have your market features, and these will be directly linked to the market perception, or essentially how the market state. Exactly. And then each row is essentially an allocation or a potential allocation that the model will be sampling through. So you look at here in the first row, we could either assign 20% of our money, loosely saying, to Google, 60% to Microsoft, Apple, 20%, and so on and so on and so on. So from the paper, you can see that, or you potentially will see that there's infinite possibilities to allocating. For instance, let's say, for instance, you have 500 stocks, like you manage to partition this S&P 500 into its separate 500 stocks. And you assign, let's say you have two positions. You can either go short or you can either go long. So essentially you have 2 to the power 500 possible allocations. And the model has to go through all of them. So it can then try to predict or try to understand which one would actually be the best allocation at the other steps. Now, of course, this poses as a big problem because I don't think we have the computing power to go through 2 to the power 500 possible allocations. I think when I saw the number myself, I was shocked how big the number is, and it's just not possible. So the authors said that to overcome this, they came up with something they called intelligent sampling. They didn't actually specify what exactly it is, and anything we can come up with this is only speculation. I potentially think it's some sort of random walk sampling of some sort, whereby it tries to put less focus on the ones that seem to be using less potential allocation and just try to focus on the ones that are maybe yielding a higher allocation Sharpe ratio of some sort, something like that. But I think there's a big mystery there in the fact that we don't know what exactly intelligent sampling is. But they said that this is, for instance, I quoted here, overcoming this curse of dimensionality by intelligently sampling the grid is one of the major breakthroughs of our team has accomplished. But which, if they put a black box there on intentionally, because we don't know what intelligent sampling is, but it's brilliant that it cuts down potentially something through to the power 500 if you have 500 stocks and cuts down. I think we don't even know how much it cuts down the time by. We just know that according to their work, it works. So I think we can go to the next slide now. So then now we can start to look at the bare bone process of how CPO works. This is essentially CPO and its skeleton. You start off with the training stage, which is step one. You take your historical market features, the ones I labeled here as, or sorry, they labeled here as market features. You take your control features, the ones that are in your actual portfolio, which is your, in that case, the Google and the Microsoft and so on. You put that into some sort of pre-processing stage, and then you get your historical features, right? And then you add your historical portfolio end day Sharpe ratio. Because remember, you want to train your model as much as possible. And then with that, then it does what, then the model then does what they said, intelligent sampling, which is trying to scour through all possible rows to see which is the best or potentially the best 1 day Sharpe ratio, for example. There's no optimization here. It's just giving results of which ones are potentially the best 1 day Sharpe ratios. And then you train the model, and then you have a trained machine learning model. Then you move to stage two, which is the inference stage. You take the current market features. So here you're looking at the historical, looking at maybe you can look at your, I don't know, 3 years or 2 years, whatever period. I think maybe it suits your preference and your computing power. And then you take your current features and you combine those with the control features. Remember, your model is trained now. You apply that to the trained model, and then you could get your predicted end day Sharpe ratio. So the objective function in this case, or in this example, is trying to predict the end day Sharpe ratio. If anything, they made it more specific that they're trying to predict the 1 day Sharpe ratio. And then you get to the optimization stage, which, so essentially stages 1 and 3 are what I would characterize as what CPO is really all about. Picking up the regime changes and now optimizing the actual portfolio. So now you have your predicted end day Sharpe ratios, you have your different allocations, and then you add your constraints. Constraints are essentially your weight. So for example, you don't want your model to end up putting a certain amount of stock, certain amount of money per se into a certain stock and try and actually potentially put you at risk. So you put like a constraint to say that for any stock, I need to make sure that the model does not go above 40%. And with cash, I need to make sure that the model doesn't hold more than 50% cash, for example. So this would be the constraint. And then they do another intelligent sampling. Essentially, what it's doing is given those constraints, which is actually yielding the best Sharpe ratio, in this case, Sharpe ratio, but it can be any objective function you want. This is the optimization part. And then it gives you essentially what is the base Sharpe ratio and the actual base allocation. In this case, would have been the first one, which was this one 20% Google, Microsoft 60%, and Apple 20%. Uh, Michael, do you want to add anything on the slide?
Yes. So the only thing I kind of wanted to point out here is those labels that they use to actually train the model. It's important to understand that those were probably back tested. So what they would do is they would take their market state and they'd take their hypothetical portfolio and they would then back test that portfolio. And the Sharpe ratio 1 month into the future, that would become the label for that particular row. And that would become a training sample, right? So you have your portfolio, you have your historical market features, and then you have the predicted Sharpe rate or your back tested Sharpe ratio. And you do that for all possible combinations, hypothetically, and then that's your training set. So I think at the end, we're going to have a little bit of a discussion on how that intelligent sampling works. I think Masimba had a good idea for how you'd maybe do that. There's a bunch of ideas when we were talking offline of how you could possibly do sampling over a very large kind of sample space with lots of dimensions. How do you reduce that down? I have a little bit of experience solving problems like this. So we were kind of brainstorming how you do that. And then once you've kind of got that, then you can actually train your model. And then like you see, then there's an inference stage where you make your predictions and then based on your constraints, you can actually optimize. So yeah, nothing more to add. The only thing, Masimba, I would say, I think the example they used is a 1 month future Sharpe ratio that they look at, not 1 day. But once again, you can choose any optimization objective function that you'd want. So for example, if you wanted to minimize variance, across your portfolio or drawdown or something, you can make that your objective function. And then that's kind of how this would work. So it's a very general approach. And yeah, we'll get into how well it works in a second, but that's basically all I have to add on the process at this point. So yeah, thanks, Masimba. You can carry on.
Thank you, Michael. So I think the big takeaway for me just on this, because I feel like it offers a nice skeleton to actually add on however you please. So, for instance, unfortunately, we couldn't get access to the source code or any coding work regarding the paper because the authors actually are implementing the strategy with clients and potentially I'm sure there's some NDA agreement or something along those lines. They're just not comfortable say, giving us access to the code work. But it's nice to get a diagram like this because it gives you a nice blueprint of how you can actually approach machine learning methodologies when it comes to portfolio optimization. And you can then fill in the blanks however you like. Of course, that would depend on your research team, how much time you have, all of these factors come into play. But I think this is good enough as some sort of blueprint to say I could have a three-stage process in trying to optimize my portfolio, in trying to actually start off with the training stage, then go to the inference stage, then get to the optimization stage. Of course, there's a lot of uncertainty when it comes to intelligence sampling and so on. But like Michael said, we will talk about that at the end on potentially what ideas could have come across in terms of what intelligent sampling is. But I just like the fact that this is a nice blueprint to how you can tackle portfolio optimization in general. Anyway, so let's go to the results now. So we have exhibit one. We have an ETF. I didn't know what this ETF was. I had to Google. It's actually a Canadian exchange traded fund, but it's good to know. It's good to learn. And the constraints they put was maximum weight on any stock was 10%, and maximum any cash is 10%. Note, cash does not necessarily mean actual cash. It could mean that, but also cash could mean an investment in a risk-free asset, for example, your treasury bond, for example. So in this case, out of sample between 2021 August to about 2022 beginning of August, you see that the ones that are the naive traditional method potentially performed amongst the worst. A funny thing, I was surprised to see the Markovits actually perform the worst. I thought maybe being that is a more advanced technique would perform maybe the second best, but Markovits actually was the worst. The naive one was amongst the worst, but CPO actually performed slightly better than the other one. The interesting part now is that by slightly adjusting the same period, same out of sample, by slightly adjusting the weights, here we now have 25% on any stock, 50% on actually on cash. CPO performs significantly better than the other ones. And that's big because I think it's natural to know that during bad times, you'd rather hold on to the most amount of cash rather than have your money or your investments dwindling to inflation, to recession, and so on. So the model is able to pick that up. By just simply adjusting cash, we see a significant change in our results. And then
Maybe sorry,
looking,
Mustafa,
yeah,
sorry to interject. I think maybe just an interesting comment about this observation in some ways that's kind of not related to the paper, but interesting nonetheless, is that your constraints, which typically are not data driven, right? You will typically have either a law or a mandate that will tell you how much of what you're allowed to actually hold. It's actually quite surprising how big of an outsized effect that can have on returns across all kinds of strategies. So I just think that's quite an interesting thing to note in general. And I've not actually seen a lot of talk about maybe setting constraints or optimizing constraints in a certain way, right? So that could actually be something. I mean, the paper doesn't talk about this, but the thinking in the future, maybe it starts making sense to have constraints be data driven. Maybe a certain set of constraints actually leads to really excellent returns. And so that's yet another facet you can maybe optimize on in the future. But yeah, I just think it's important to kind of notice this in this particular case.
thank you, Michael. So, look, moving on further, now we get a bigger picture of how CPO is actually performing versus the more traditional approaches to portfolio optimization. So, we have a private tech portfolio, 7 US stocks, 2 Canadian, and on the y-axis is portfolio value. I don't know what exactly that means, but portfolio value, I assume the higher the value, the more Sharpe ratio, or whatever the case is. And then on the x-axis, you have time. So you can see that, for instance, during bull markets, perhaps between January 2020 and maybe up until January 2022, CPO actually capitalizes well in these bull regimes. So if in this maybe 2017 to about 2020, there's not much of a difference. It's interchanging. You can't really tell which one's doing well. But the moment there's a bull market or a bull run, rather, the 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 model is able to capitalize more on these markets, right? And then, as you can see, potentially around 2022, January or maybe February, which is in line with the actual Ukraine-Russia war breakup. Now we have some sort of change in market regime and we have a dip. And CPO seemingly is hedging well against this regime change. Yeah, compared to you looking at your equal weights, your max Sharpe ratio, your minimum volatility, and so on. And this is quite significant because we'll see in the next slide here that at any point where there was some sort of max drawdown, CPO allocated the most to cash, as you can see here with this on this diagram here, versus the max drawdown here on an S&P 500. And this is essentially what maybe Michael was also iterating, that the constraints are significant in trying to optimize or trying to protect your investment in a portfolio. Because the more amounts you assign to cash, like naturally speaking, you don't want your money or your investments dwindling when it's times of that. So you want to hold as much cash as possible. And CPO is managing to do that, almost hedging against bad times. And I think that's quite significant in how the authors brought this to light and actually perhaps introduced a new way of portfolio optimization. And here we have two diagrams. So the top diagram, they try to essentially maybe test CPO against these new age assets like your cryptocurrency. So the top diagram has eight cryptocurrency portfolio. It's a portfolio with eight cryptocurrencies, sorry, and it's allowing for short positioning, aiming to maximize its 7-day forward Sharpe ratio. And I mean, there's a significant change here. Sorry, significant difference here of Sharpe ratio being significantly higher with CPO. And sorry, the out of sample period here was between January 2020 and June 2021. Ideally, I would wish there was a longer period, but we take what we have, and this is the period they use for this experiment. And below is a bit of one of their clients, which they said that they had to ask for permission from WSG Investment. So this is the results from a portfolio of 7 trading strategies. And I think WSG is a Forex trading company. I'm not quite sure, but they essentially deal with Forex. So this is also trying to show how CPO deals with different types of assets and seems to actually do well with those different types of assets. Again, the out of sample period for the WSG investment result is between January 2020 and July 2022. Not the best in terms of the length. Ideally, would have been better if it was longer, but they included July 2022 to try and show how it flares even when there's some sort of dip in the market, which is demonstrated by the Ukraine war breakdown in 22 in February 2022. Now, then they were not shy to show some interesting results per se, whereby CPO may not actually be the best in terms of the optimum strategy in terms of portfolio optimization. So they created what they labeled tactical asset allocation, TAA. This is inspired by the Golden Butterfly portfolio, if you're aware of them. And essentially, the portfolio comprises of small cap stocks, large cap stocks, which is your SPY, your 1 to 3 year Treasury bonds, SHY or SHY, and your 20+ year Treasury bonds, your TLT. And in sample, here's a surprising fact here. In sample, equal weights had a Sharpe ratio of 0.51. CPO had a Sharpe ratio of 0.63 between the period of 2015 January and 2018 December 2019 January. Right. You wouldn't think equal weight would end up performing better out of sample. But when they then took it out of sample, incorporating that regime change that I keep mentioning, the Ukraine-Russia war that broke out in February 2022, equal weights actually outperformed CPO. CPO actually performing second best. And they did mention that this was a bit of a surprise because they wouldn't have thought that in sample, equal weights didn't show any signs of potentially being the better option in terms of portfolio optimization. But out of sample, in that significant out of sample period, equal weights was actually the best, and CPO was second best. But also trying to reiterate that CPO still will be able to perform well in this customized portfolio that was created. So I found that very interesting. I'm sharing the same sentiment with the authors that I wouldn't have thought equal weights would have been the one that would perform the best out of sample in that period, given that we know equal weights is slightly seen as a naive approach or some sort of naive strategy because it's entry level. But maybe this thing gives us an idea amongst many others, that we need to take the results with a pinch of salt. But anyway, we'll talk about that in the conclusion and so on. And this is just to reiterate the out of sample allocations that CPO would have made. Of course, maybe it would have been better to also see equal weightings and how that was happening, but we're just going to have to look at our CPO allocation. So this is also trying to give an idea of how it rebalances or readjusts itself over time. And they did mention that the model rebalances, I think, every 7 days or something like that. Correct me if I'm wrong, Michael, but I think it's something like that. So between 2021 January, we start off with a large chunk of our portfolio in cash, which is shy. We said cash does not necessarily mean actual cash. It actually means a treasury bond or something that's risk-free. It then readjusts that towards the end of 2021 or midway rather to have more in your S&P 500 or in some sort of optimistic stock to see maybe potentially a rise or potentially investor confidence rising or something like that. And then looking at the beginning of 2022, a lot of our asset was in gold. And this dramatically changes towards mid 2022. Remember, after the significant event, now we have a significant amount of our money in cash. And I feel like this is just to show how it keeps rebalancing and rechanging itself to always have the optimal allocation towards which assets should, in terms of which, with the constraints you would have said, how much of the assets should we hold, and so on and so on. And this is, I think, I feel like this is also proving why CPO is potentially a game changer in this optimization industry, in the uh, in the capital optimization industry and trying to actually see the optimum number, or sorry, the optimum portfolio that can be held. Because when I started off as a quant and trying to understand quant, all I knew or all we were taught about is equal weighting, which is just trying to use the correlation matrix, make sure that you hold assets that are opposite correlated to each other or inversely correlated to each other to try and diversify your risk. So now we talk about the conclusion and we've come to the end. So I think the main takeaway that I would want you to go with is that CPO is a two-step approach, right? The first approach is the actual regime identification. Second, um, the second step is actually the optimization process. There's an intermediate step, but just at the core, those are the two findings of what the paper is bringing to the table. Interesting results. Now, we have a mixed bag. We have a situation whereby uh, we have a situation whereby CPO has shown great potential from the results, which I do believe they're not enough. But anyway, from the results, CPO is actually performing well against what most fund managers will be using to optimize their portfolios. However, which is a bit fair that they did include a scenario whereby CPO wasn't actually the best. Although it did perform well, it wasn't the best. And this also then puts in the question of timing is everything when it comes to portfolio investing and portfolio management. Now, number two, machine learning incorporation equals significant improvement. I think one theme we share here at Husband and Thames is we're trying to be the forefront in understanding machine learning algorithms and how they actually can influence our world today. And the beautiful part about today is that most of our computers can handle so much workload in terms of computing power and so on. So machine learning is an integral part of what conditional portfolio optimization is. But I think take it with a pinch of salt because I feel like we need more results. One thing I do feel like, which I was discussing with Michael, is that they tested on very short time frames. I wish there was a longer time frame to test on. They tested on very specific data sets. Potentially, you see, if they had maybe given us access to some of the coding, we could have done our own experiment on some sort of random asset allocation to see how that flares up. And I also feel like there's very few implementation details. I did mention earlier on that the paper reviews a lot, but it doesn't review much at the same time. And this is quite sad because the methodologies that are being applied in the paper are groundbreaking and can actually help us move forward our portfolio optimization techniques. However, there's not enough coding work or not enough there's not enough information surrounding, for instance, intelligent sampling to understand how exactly is the model working and which models are actually being used to do some of this work that you claim. Because they did mention, like I said, neural networks, but there was a small disclaimer or small note at one of the pages saying that they actually mostly use XGBoost. So I feel like there's sorry, I feel like there's very few implementation details regarding the actual methodologies. And I think my final caveat is there needs to be further research needed to explore its applicability in different markets. And that could have been done if perhaps gave us access to some of the coding work and some of the implementations on maybe on a Python notebook so we can actually follow along and we can also potentially do our own experiment. Um, they did mention that due to the fact that they have seen success with their methodology, that they had to essentially make it into a product. So if you're interested in trying to implement the product, I think you can visit, I don't know, their website or something. But the idea behind not giving us the code work is because their implementation has been so successful that they actually package it into a product, which is unfortunate for us researchers. But nevertheless, I feel like we can always go back to that skeleton framework that I showed you, which is what they gave us, which could be something we can lean on to try and give us an idea of how everything is working, more like the brain behind everything. But of course, there's a lot of research that will need to be done to actually understand each component at each stage of what is actually going on with the methodology of CPO. And I think with that, I would just like to conclude and hope you enjoyed today's presentation.